Good afternoon, everyone, and welcome to the defense of my PhD thesis, The Value of Unstructured Data, Essays on Information Disclosure. I'm more than happy to share the results of my dissertation here today, and I welcome everyone who made it possible to be here today, and of course especially a thanks to the Doctoral Commission. In today's talk, I'm going to present three parts. At the beginning, I will give a quick introduction on data and decision-making in the context of financial markets. Then in the second part, I'm going to present you one work in particular in the deep dive session. And third, I will give you an overview over my dissertation in the bigger picture. Let us begin with the first part. This is a picture of the German stock exchange Deutsche Börse, one of Europe's largest financial marketplaces. What you can see here is a room with lots of screens, numbers, charts, tables, and people trying to make decisions. At the core of the financial markets is data. And this data is used for investment decisions, whether to buy, to sell, or to hold financial products. And these investment decisions are informed or guided by financial models that leverage data to achieve better investment decisions. Now, data can be used in various ways. First, it can be used for forecasting. So using historical data, you can try to assess and anticipate future developments. Second, you can use data of financial indicators to assess the company's financial health, to diagnose how likely a bankruptcy or a stability of the company is. And third, you can use data in order to generate insights and recommendations, such as buy and sell ratings or credibility ratings. In order to be successful on financial markets, it's important to do things a little bit differently than everyone. The true advantage on financial markets comes from reading what others ignores in a flood of information that we experience today. And especially unstructured data, as I'm going to convince you today, might be a lever to do so. Now, data can be classified in structured and unstructured data that differ in organization, form, and processing. While structured data often comes in standardized formats, such as tables and often in numbers, which makes it simple and efficient to process, unstructured data often comes in a variety of different forms, including videos, texts, images, or audio signals, and this makes it especially challenging to process. However, unstructured data, because of its complexity, is often overlooked by the others. So is there value in unstructured data when making decisions? In fact, interpreting unstructured data and reading signals from unstructured data is often prone to cognitive biases, such as bounded rationality, the limited attention that impedes you from incorporating all available signals and data. Second, loss aversion, the tendency to weight losses higher than potential gains. Third, herding behavior, so the tendency to follow others, mimic their decisions, resulting in mass panics. And here, especially if you use the same sources of data as everyone else, you probably come to the conclusions as everyone else. And the hindsight bias, so believing that past events have been predictable, have been explainable with the data available at that point in time. Fortunately, there have been advances in processing natural language, and these advances are key enablers for new opportunities to process unstructured data in an automated way. First of all, there has been an approach called bag of words that basically addresses counting words, and the word frequency in texts, for example, indicates potential sentiments or other aspects. Topic modeling is kind of a clustering approach. It leverages counting the occurrence of words and their co-occurrence in different documents in order to identify latent topics that might be of interest for further insights. And last but not least, the new kid on the block, large language models, which models language or any sequential data as probabilistic Markovian object. And in contrast to the previous methods, large language models can consider context and word order, making them a powerful tool processing unstructured data. So the research question of this dissertation is therefore, can we improve decisions leveraging the value of unstructured data? Not only can we, more importantly, how can we? And also should we? Is it really worth the effort? There are 4 specific research objectives to address this research question. First, we try to understand the determinants of incorrect assessments and decision making. Second, we try to suggest and validate policy recommendations to regulate information mediators. Third, understanding the contribution of unstructured data as a complement to structured data. And fourth, overcoming methodological challenges when working with unstructured data, providing a toolset. The dissertation consists of 5 scientific contributions that highlight the value of unstructured data. Mostly they were related to credit rating agency and signal processing in this context, and they cover different aspects such as external factors, but also, more interestingly, internal factors of credit rating agencies. In the second part of this presentation, I'm going to show you now in particularly one specific work, which is entitled Diversity Pays Off: How Analyst Team Diversity Improves Credit Ratings. In this study that addresses the first 2 research objectives, we show that team diversity moderates rating quality. And if you wonder about the picture, it's basically regarding complex problems from multiple perspectives to improve decision making. To start with, as a background to this work, what are debt markets and bonds? Well, bonds are a form of fixed income product. It's basically a contract between investors and issuers, and it's kind of a lending. So at the beginning, the investor lends money to an issuer, over the time receives regular interest payments, the so-called coupons, and last but not least, at the very end, when the bond product matured, we receive the principal payment back. Now, an important question in the context of bonds is to anticipate the issuer default, meaning the bankruptcy, the inability of the issuer to pay back the obligations, such as the coupons and the principal payments. Now, there are 2 ways to anticipate issuer defaults. First, by diagnosing the company's financial health using structured data, using financial indicators, but also keeping up to date, regularly following recent events and issuer-related news. That would cover unstructured data. Unfortunately, investors do not have access to all available data. There is non-publicly available data issuers are aware of, but keep them part as their business secret. For this purpose, governments have legally mandated credit rating agencies that bridge the gap of information asymmetry in this context. Famous 3 credit rating agencies are the big 3, S&P, Moody's, and Fitch. You might have heard of them before. Now, these credit rating agencies are financed by the issuers and granted exclusive access to internal reports, interviews, and the opportunity to talk with employees and board members. And by having access to this exclusive data, credit rating agencies can assess the situation and publish the credibility, the credit rating that reflects the default risk to the public, to the investors, ultimately creating trust on this market. Now, credit ratings are basically a ladder, and there is a scale representing different credit rating levels for the 3 different companies, Moody's, S&P, and Fitch. And there are long-term and short-term assessments or credibility statements depending on the maturity of a bond product or fixed income product, if it is longer or shorter than 1 year. Now, credit ratings have a material impact on investment decisions. First, because they enjoy significant attention and are considered as signals for risk and default. But more importantly, many investors, such as public pension funds or governmental or municipal funds, have the obligation to follow recommendations of credit rating agencies, and in case of downgrades, are even obliged to disinvest, to sell their fixed income products, or to renegotiate to achieve higher coupon payments. Therefore, optimally or ideally, changes in the credibility of an issuer would lead to changes in their credit rating. But due to the role that credit ratings play on the debt market, it might also be that changes in ratings can cause significant challenges for issuers to finance them, and therefore achieve real changes to the credibility itself. Even though credit rating agencies play such an important role on debt markets, yet history has shown that at many times credit rating agencies have failed to accurately and timely predict issuer defaults. Examples include the Orange County bankruptcy in '94, the Lehman Brothers bank collapse 2007, and also the European sovereign debt crisis in the 2010s. Previous research has shown structural problems and cognitive biases that help to explain why credit rating agencies have failed. And credit ratings is a complex task, mainly due to 4 reasons. First, it is conducted in teams, so often teams of 2 or 3 analysts work on credit ratings. Second, there is a significant time pressure because rating agencies and their analyst teams need to respond to immediate news, recent insights that become public and therefore require an ad hoc response. Third, collection. Not only is publicly available data used in their decision making, but also internal reports or interviews with staff and board members conducted, and this collection of data therefore is quite effortful. Fourth, structure. Not only is structured numerical data used in their assessment, but the value of unstructured data is leveraged and therefore requires elaborate methodology and intuition. When solving complex tasks, sometimes in life, it can be useful to use multiple different perspectives on the problem to improve assessments. And as we know, reading information signals from unstructured data requires interpretation, which is prone to cognitive biases, and therefore looking at the same problem as a team with different perspectives might help. Therefore, the research question in this publication is, do diverse analyst teams produce better ratings or not? The first question we need to clarify is, what does diversity mean? And the second is, what does better mean? So in terms of diversity, there is a very common definition from O'Reilly et al. That states that diversity refers to any attribute that can be used to detect differences between individuals. This commonly relates to gender, race, or age, but it can also relate to working experience, education, and many other aspects of team members. In the literature on the relationship of performance and diversity, there are mixed findings, however. So there is a branch of literature claiming that diversity improves team performance following the information processing theory. In this theory, basically, diverse teams are considered to offer perspectives and skills that even lead to super additivity. So the sum of its parts is greater than the separate sum of its components. And on the other hand side, there is a branch of literature that finds the opposite. Similarity attraction theory and self-categorization theory state that diversity in teams is an impediment to efficient teamwork and an impediment to team building. There are many studies for and against this relationship, and this is why we find our research even more topical, even more interesting to study. Now, what makes good ratings? Credit rating quality is a simple equation considering accuracy and timeliness. Accuracy here refers to that the credit rating should accurately reflect the risk of an issuer to default, and it should also go beyond the scope of structured data of financial metrics that everyone on the market has access to. Second, timeliness. So it should anticipate the default of issuers before they happen and not simply reflect market dynamics when everyone else already found out. Also, it is required to have an ad hoc response to latest events and be able to anticipate long-term perspectives through market cycles. And ideally, having continuous and stable ratings that don't need to be adjusted all the time. Let us have a look on the data we collected to answer our research question. We first of all retrieved credit rating data from the big three, Moody's, S&P, and Fitch, including more than 47,000 unique rating actions from more than 1,700 authors or credit rating analysts from more than 2 decades. This provides us with properties about the ratings such as the date, the rating before and after the event, the rating type, was it an upgrade and downgrade, an outlook and review, the authors that caused this rating event, and also the full text report that is accompanied with such a rating action. Second, there is biographic data from LinkedIn. We were able to identify more than 1,400 analysts on LinkedIn, retrieve their experience, their education, their facial images, and we were able to provide biographic properties such as name, gender, race, age, certifications with Master of Business Administration or Certified Financial Advisor, education and experience. And last but not least, there is financial data that was retrieved from Thomson Reuters, including mostly structured data in the form of financial fundamentals. This data enabled us to compare the credit rating agencies, and in fact, we found significant differences between the rating agencies and their staff in terms of age, gender, race, education, certification, work experience and rating experience, and also the workload. To summarize this chart, while S&P attracts mostly younger and more female analysts, Moody's attracts those with a higher working experience, but with an older age. And in the middle field, we have Fitch Ratings that attracts working horses with significantly higher workloads and more education compared to the other rating agencies. This data set was leveraged to understand the research question, to address the research question. 3 regression models have been used to assess the accuracy and timeliness of credit ratings. The first regression model is an ordinary least squares regression model that tries to explain abnormal ratings, so deviations from purely structured data-based financial models. And the second 2 models are a logistic regression and Cox hazard regression model that try to explain rating changes and the time to rating correction, reflecting the timeliness, the continuity of credit ratings. These regression models have been fixed effect regression models and partially also panel regression models. We controlled for multicollinearity using variance inflation factors and found no issues with heteroscedasticity. Now, what are the different control variables and fixed effects we used? We controlled for diversity using team size, gender, and race. Moreover, as not for all rating analysts, the LinkedIn profile was available. Where possible, we identified education, age, rating experience, and a company experience, so the cumulative number of ratings that a specific analyst already accompanied this specific issuer. And on the other hand side, we have the fixed effects that we incorporated based on the literature. And to name an important paper here, that is one from the Journal of Finance that recommends to include fixed effects on agencies to account for differences across the rating agencies, quarter to account for dynamics over time, firm to account for differences in issuer, industry to account for industry differences, and also mixed effect interaction terms such as agency and quarter. Now, the first regression model tries to understand abnormal ratings. What does that mean? Basically, we can observe the actual credit ratings for many different companies, and then we can estimate those with a purely financial structured data-based approach. And in fact, we can explain more than 89%, 98% of all credit ratings purely with structured data. But the deviation of this is where the value of unstructured data comes into the game, where the incorporation of unstructured and non-public data and human rating analysis makes the difference. And if analyst team diversity affects this deviation, that would indicate that analyst team diversity serves as a mediator for credit rating quality. The results in the following are displayed as regression model tables. We see on the top the different regression models, on the left-hand side different variables that were included, as well as the fixed effects. The 9 different models are different for the different fixed effect combinations used and also the variables incorporated. The diversity was often grouped in 2 separate groups here because for team size, gender, and race were available for almost all analysts, while the later 4 diversity measures were only available for a small fraction of all data, which is why we chose to separate this. The insights of the first regression models are that team diversity contributes significantly explaining the deviations from fundamental models, and we therefore interpret this result as that team diversity might affect the rating philosophy of teams. Especially team size, so the number of analysts, and racial diversity played an important role here. The second analysis was about rating changes. So while at the top we see credit ratings over time, at the bottom we see rating changes the first time derivative. If we now assume there are 2 ratings, black and blue, we can observe that the blue one changes less frequently. This is because the blue one might argue, has a more long-term perspective on the issuer and therefore has more accurate through market cycle assessments when compared to the black one. And this rating stability might be achieved through more team diversity. The results of a logistic regression model that tries to explain whether the rating was changed or not indicate that diverse teams change ratings significantly less often, which could be interpreted as that diverse teams produce more stable ratings as they require less adjustments, and therefore team size, gender, racial, education, and a company experience diversity especially contributed to this. The third model was a time to rating correction, a Cox hazard regression. The basic idea here is to assess how long it takes to change the next rating. And the longer this time for a change is, the more it indicates that the rating is continuous and long-term forward-looking. The result of this Cox regression hazard model indicates that diverse teams have longer times to rating corrections, as we see here. The survival ratio, the hazard ratio increases positively. Diverse teams have more continuous and more stable ratings. And last but not least, all forms of team diversity significantly contributed to this. To summarize, does analyst team diversity improve accuracy of credit ratings? We had a look on the analysts that use data, and we identified, based on a very large data set, different biographic features to identify analyst team diversity, and assessed whether the research question is valid or not based on different characteristics and measures. And ultimately, we would argue there is indication to confirm that probably diversity in analyst teams leads to more accurate and timely ratings, in particular more critical ratings, less frequent rating changes, and more alignment with market-based indicators. With that said, we come to the last part of the presentation, the bigger picture. I tried to ask myself, how can I summarize the previous 3.5 years just like that? And here is what I found. The first way to summarize my work is to regard my 5 publications and how those address the 4 initial research objectives. What I found more interesting, however, is to not only state the fact that I found significant evidence that there is value of unstructured data, but I don't want to hide from you that it is also complex to leverage this value, and also it is effortful to collect data. In my dissertation, I have compiled many large data sets, including a large credit rating data set, around 70 gigabytes of rating reports, that led to the first publication. Then we combined this large data set with a merger and acquisition data set, leading to the second publication. And it looks so easy here on this slide, but merging data sets, especially if the quality of keys to match different records is, for example, of not a good quality, comes in different formats, or different records have different keys available, makes matching challenging. Third, we had retrieved the rating analyst biographic data set from LinkedIn and matched that again with the credit ratings, leading to the third publication. And here, for example, we used full analyst names as a key. And as you can imagine, analyst names come in different forms, such as a Thomas could be called Tom or Tommy. And therefore, it was effortful to create a correct matching table. Last but not least, there was also a very large data set on scientific papers, more than 66,000 full-text papers from the top 27 journals of business administration and economics, leading to the fourth publication, and the fifth one was a purely methodological contribution. Of course, structured data was used from Thomson Reuters, but using unstructured data, as you can see here, is much more effortful. What I learned on my way is that it takes 6 aspects to be successful when leveraging unstructured data. First, you need a network of people that have an access to databases or capabilities to retrieve data sets online. Second, you need patience. It can take weeks to months and multiple runs to successfully download everything that you want to use. Perseverance, because websites change over time, data disappears, and if you decide to re-download, you need to be creative and find ways to combine old and new retrievals. Fourth, scrutiny. When checking downloaded data, don't trust in very large data sets. You will always find inconsistencies in matching or downloaded data. Fifth, common sense, as regarding what is and is not possible with given time, computation resources, and the data at hand. And last but not least, sixth, domain knowledge to validate the consistency and quality of data sets. The last way to reflect on my dissertation is an unstructured yet valuable way. It's a word cloud. The word cloud shows different words that were used in my dissertation in larger font size if they have occurred more frequently when compared to other terms. And as you see, I talked a lot about data, credit ratings, financial processes, diversity, market information, and more topically, I touched upon various different topics that you see here in the blue bubbles on the left and the right, such as debt markets, diversity, natural language processing, etc. With that said, I thank you all very much for your attention, and I'm now looking very much forward to the discussion and the Q&A session, and I really hope that I could convince you on the value of unstructured data. Thank you very much.